Now, they haven't exactly agreed what fiscal union will look like. What they did agree late last year was that there would be a role for the European Union to not just oversee and monitor fiscal policy, but actually to have a role in approving national governments' fiscal policies. Now, how would that work in practice? Well, the German proposal is the following. Cabinets in individual countries would decide on their budgets for the following year. They would send that budget to Brussels. The European Commission would say yes or no. It does look like it is consistent with the targets that we have collectively set for your fiscal policy over the next 5 years. Then the budget goes to Parliament. After Parliament deliberates and approves the budget goes back to the European Commission to make sure they haven't deviated from the plan. The European Commission then would be able to dictate to governments how much they can borrow through the cycle, as we call it. They wouldn't necessarily tell them how to set tax policy, how to set expenditure policy, how to define healthcare and other entitlement policies. That would remain a national prerogative. But Europe collectively would agree on how much each country, and therefore Europe as a whole, would borrow each year. And the EC's role in that would be to make sure that each government was sticking to its part of that collaborative fiscal policy. You can imagine that after a few years of coordinating fiscal policy like that, it may not be too difficult then to go the next step and create a single European debt management office to borrow on behalf of all these governments. But the fiscal union that I've just described is probably 5 years away at least. A single debt management office is probably 7 or 10 years away at least. It will still take a number of years for each government, for first of all the governments to agree precisely what fiscal union is, and then for each government to enact constitutional reforms or whatever legislation is required to put it in place. But there is a long-term objective to fix the European Monetary Union by adding a fiscal union, and Europe now has all of the tools it needs in the short term to manage the adjustment policies that peripheral European economies need to continue to implement in order to regain market access. So what is happening in terms of these adjustment programs? Well, an awful lot. And this is something that gets missed in all of the Financial Times, Wall Street Journal commentary on Europe. These economies in Southern Europe and Ireland have adjusted tremendously. For example, there's essentially two macro imbalances that these economies had. They were running large, in some cases, current account deficits, and by 2009, large fiscal deficits. When we look at the current account side of the picture, just Ireland, Portugal, Greece, and Spain in the middle of 2008 were running current account deficits of about 200 billion euros. In Greece, that was close to 10% of GDP. By the middle of this year, that four-quarter rolling current account deficit was less than 50 billion euros. In July, all of those countries ran current account surpluses. Ireland has been running a current account surplus for a few years. Spain and Greece and Portugal are maybe 6 months away from consistent current account surpluses. Relative unit labor costs have fallen more than 20% in Ireland since 2008. Wages have come down in Ireland, wages have gone up in Germany. In Spain and Greece, the relative adjustment to unit labor costs over the last 2 or 3 years has been in the neighborhood of 10%. So we are seeing the real improvement in competitiveness in peripheral European economies, and that is reflected in export growth from those countries that would make Asia proud, and a shift from very large current account deficits to current account surpluses. What's happening on the fiscal side? Well, there the news is even better if you're an investor. These countries, Ireland, Portugal, Spain, and Greece, in 2005 and 6 ran what we call cyclically adjusted primary fiscal balances that were in deficit by about 3% of GDP. Now, cyclically adjusted primary fiscal balance is a long word or a long title for what is essentially EBITDA for governments. It is revenues minus expenditure before you pay interest, but adjusting revenues and expenditures for where you are in the cycle. Because when you're in recession, as Europe is today, your deficit is going to be exaggerated. Revenues are going to be unusually weak. Expenditures, when you have welfare programs, will be unusually large. So as economies recover, the primary fiscal balance will improve. So to assess the current stance of policy, economists estimate the cyclically adjusted primary fiscal balance to get a sense for whether policy today, if the economy magically were to return to full employment, would be consistent with a deficit or a surplus. In 2009, for those countries, that cyclically adjusted primary fiscal deficit was 9% of GDP. This year, it is expected to be about 2% of GDP. Greece is forecast by the IMF in their latest forecast, they came out last week, to run a cyclically adjusted primary fiscal surplus this year of more than 1% of GDP versus a deficit of 7% of GDP 2 years ago. Spain will run a surplus next year. Ireland has been running surpluses for the last couple of years. Italy always runs cyclically adjusted primary fiscal surpluses. The need for Italy to tighten fiscal policy the way Greece or Spain have is simply not there. All of these countries need to see these cyclically adjusted primary surpluses improve because their debt to GDP ratios are too high and they want to bring them down. But mathematically, if you had normal-looking interest rates and your economy was growing even slowly, if you're running a primary fiscal surplus, you would be each year paying down the debt. So at a minimum, we need to see these countries tighten fiscal policy a little bit more, but where they are today, compared to where they were 2 or 3 years ago, this is about as dramatic a fiscal adjustment as we have ever seen. Now, the maths for GDP growth as it relates to fiscal policy is a little bit difficult to think through for many people. The newspapers will tell you that as long as these governments are tightening fiscal policy, Europe will stay in recession. The newspapers are wrong, because what matters for GDP growth is the growth in government spending, the growth in government revenues, whether the primary fiscal balance is rising or falling. In the same way that it doesn't matter whether whether government spending is 10% or 20% of GDP, what matters is whether it's growing or shrinking. It is the change in the fiscal deficit that influences GDP growth. And when we look at the IMF projections for this year versus last year and next year versus this year, what we find is that the fiscal drag on growth in Europe, the change in this cyclically adjusted primary fiscal balance, is the same this year as it was last year. So even though governments are running tighter and tighter fiscal policy, the impact that will have on GDP growth will be the same this year as it was last year. And next year it will be half, it will fall by half. So the contribution that fiscal policy will make to GDP growth in 2013 will be positive. Now, this sounds a bit like talking in second derivative terms, and I'm going to do a little bit more of that in a couple of minutes. But this raises the question immediately. If Europe grew 1.4% last year, why is it it's expected to shrink by 0.5% this year if fiscal austerity isn't the explanation? If the fiscal contribution to growth is minus 1.5 percentage points of GDP this year and it was minus 1.5 percentage points of GDP last year, why is the economy in Europe shrinking? The answer is private demand growth has turned negative. Why? Well, to some extent, all of this news and higher tax rates around fiscal policy have weighed on investor and consumer sentiment. But there's another more interesting or more important problem in Europe, and that is at the same time governments are tightening fiscal policy, regulators have imposed on European banks significantly higher capital and liquidity requirements. Now, in the years leading up till 2008, regulators were starting to warm up to the idea of counter-cyclical bank regulations. When times are good, you raise capital requirements to try to dampen credit cycles. And then when the economy slows down or goes into recession, you would have room to ease capital requirements so that banks aren't forced to delever their own balance sheet and call in loans quite so much. Unfortunately, Europe has chosen to do exactly the opposite of that. At the same time, the private sector is trying to repay debt and governments are trying to run large primary surpluses, banks in Europe were faced with very significant increases in their capital requirements. Now, here there is good news. As the European Banking Authority reported last week, banks have raised 200 billion euros in Tier 1 capital over the last 11 months now. That was at least as much as was expected. And our expectation is that while banks will continue to raise capital, the pace at which they raise capital, so the pace at which they are repairing their balance sheet, will start to diminish. So there's a parallel here to the logic around fiscal policy. In the same way that fiscal policy will continue to get tighter, fiscal deficits will come down, primary surpluses will rise, that will happen more slowly over the next couple of years, which will tend to support growth. In the banking system, banks have been forced to withdraw credit from the economy because they have been hit with this very significant increase in their risk-weighted capital requirements. As the need to raise capital and reduce risk-weighted assets diminishes, it will be easier for banks to ease up on that credit tightening. The best way to understand the link between banking activity and credit on the one hand and GDP growth on the other hand is to look at the change in the flow of credit, not the change in the stock of credit. So we're again talking a little bit in second derivatives. The change in the stock is the flow of credit. That flow of credit has been significantly negative over the last year. Not as bad as was in 2009, but probably other than 2009, the last 12 months have been the worst credit tightening Europe has seen in decades. As the pressure on banks to withdraw credit recedes, because more and more banks are comfortable with how much capital they have, and the regulators, more importantly, are comfortable with how much capital they have, that credit impulse will turn positive. So whereas we've hit Europe with fiscal austerity and a withdrawal of credit, over the next 6 and 9 months, we're going to see an easing of that fiscal restraint, an easing of that credit constraint. And in our expectation, by the middle of next year, Euroland will be growing again. So, in our view, Europe recedes into the background over the next 6 months as a source of concern. Unfortunately, over the next 6 months, the US will probably replace them. What's going on in the US? Well, in Europe, we've had this aggressive fiscal consolidation over the last couple of years. Everybody in Europe clamoring to tighten fiscal policy, probably inappropriately. It would have helped Europe, to be honest, if Germany had not tightened fiscal policy last year as well. The US, when we look at US fiscal policy, was very smart. They delayed fiscal consolidation until the private sector could get back on its feet. And if you look at households in the US, they were deleveraging, bringing down, repaying debt, bringing down the debt to income or debt to assets ratio from 2007 until last year. And for the last 3 or 4 quarters, that deleveraging process